So, do you have any question up to that point?
No.
Yeah, I wanted us now to start on interest rate risk management, which we have already touched a little bit on. But then we'll now look at it in detail. For example, the measures and how to identify it and how to hedge ourselves. Because there are also different types of interest coverage. The risk, and even the one I even talked on a bit earlier, optionality risk. Eh? The option that a customer has to either pay a loan they can even prepay. Customers, let's say it's a floating rate loan, okay, and the prevailing market rates reduce. So customers will even offer to pay when the interest rates come down, to pay more, prepay, and that's a risk because it can impact you. Because the profits, for example, that the bank will have made if the loan has been paid throughout the period is less than what, I mean, it's more than what it will make if customers prepay. And then we'll also how to see how to even identify those types of risks, and also how to hedge ourselves against those types of risks. And we'll also do a little bit of stress testing and to see, just as we just saw how regulatory requirements impact ALM strategies, we can also see how regulatory requirements, for example, by the RMB, affects even our interest rate risks and our hedges and our mitigation strategies against such types of risks. So to start off, we had talked about even interest rate risk before yesterday. It's the risk that due to the fluctuation of interest rates in the economy, and interest rates can fluctuate in the economy due to a whole lot of factors. For example, the prevailing market conditions, even currency fluctuations can all impact on the interest rates, especially for a bank that has foreign currency denominated loan portfolios. Okay, so when, for example, a currency weakens or strengthens, then corresponding interest rates will also fluctuate. And the banks basically deal on interest rates. It's all about, that's all banks are. It's the basis of their profit making, and also even on their operations, for example, in their lending operations and also deposit taking operations. So let's say market interest changes for for example, the market interest rate changes, and then we saw how that can affect, for example, the rate sensitive assets and also the rate sensitive liability. We just saw and then now we analyze that graph. So the rate sensitive assets in a bank, for example, are affected by interest rate risk, since interest rates, as we have seen, can fluctuate. So let's see how in what different ways this interest rate risk can impact, for example, our ALM strategy, and also even our just the large asset liability mix. Okay, so let's say repricing is usually a loan. Deposits are usually, so you are supposed to pay at a fixed rate. Okay, fixed rate loan. Okay, and then you have a 1 year loan, 1 year deposits, because deposits 1 year deposit. Okay, which you will say, just for clarity purposes, you are also supposed to pay at a fixed rate. Okay, so let's say if interest rates rise, they'll affect those asset and liability mix differently, because one, when interest rate rise, the cost of the 1 year deposits will rise. Yeah. It won't be no longer cheaper deposits. But let's say the fixed rate of, the loans, you told your customer to pay you at a fixed rate. If it was a 10% 5-year loan, then it will remain a 10% 5-year loan. No, regardless of whether the market, for example, the deposit rates increase. So a customer gives you a 1 year deposit, Eh? After 1 year, they want you to pay them back in 15%. Okay, 15% interest rate. But customer that you lend the customer the money, the customer that you lend the money, you remember the example I gave of you giving me some money and then I give somebody else, I lend to somebody else, regardless of whether they'll pay me the same, regardless of whether you require more, because you need more, because the market interest rate also, I'm not operating in a vacuum. Other banks are also offering higher rates, so I will be forced to even pay more for them. So it will no longer be cheaper deposits. So the cost of deposits that I'm using to lend will have arisen, whereas the interest income will have remained because it's a fixed term interest. So that kind of risk is called a repricing risk. Repricing risk of a repricing risk in interest rate risk. Okay. Let's say another one is also the basis risk. You know, banks operate on basically lending and also borrowing, right? You borrow yourself as a bank, but also you lend. I know borrowing and lending may be the same terms, but in the context of a bank, they are two different things, right? So, let's say as a bank, your asset and liability mix relies on short-term borrowing in the interbank market, and we saw the rate of borrowing in the interbank markets. For example, the London interbank borrowing rate, interbank offered rate, and also the soft overnight finance rate. Soft overnight what rate? Financing rate. Okay. So let's say you lend. Let's say you do this. You as a bank, your funding sources, we have seen that it relies heavily on short-term interbank lending or interbank borrowing in this case. So you are borrowing at, let's say, the LIBOR rate, which are the LIBOR and the SOFR are usually different. Okay, so you are borrowing at, let's say, 10%. No, it's usually lower than that. Say the LIBOR rate is 5%, but you are lending because you also, as a bank, you also transact with other banks, right? You also lend to other banks. So let's say you borrow at 5% at the LIBOR rate, but you lend another bank, another, let's say Nedbank in Malawi, approaches you, they also need you to lend to them. Let's say you lend to them at the SOFR, because the SOFR is usually mostly used because it's the actual percent. So that mismatch, okay, the one you are lending to Nedbank, okay, at the LIBOR rate, at a London interbank rate, for example, 5%, but you lend to Nedbank at the SOFR, the soft overnight financing rate, at, let's say, 4%. So that mismatch in the interest rate between, for example, the lending and the borrowing rate as a bank for you can also constitute a risk, because that mismatch and that gap will now lead to the interest rate gap and risk eventually. So that's what basis risk. So that's the second. So the LIBOR and the SOFR. Also, let's say optionality risk, that's the third one. You see, I talked about it. Let's say the 5-year loan that you give to a customer, you lend to a customer a 5-year loan. Okay. They're supposed to pay, let's say, 15% after 5 years, right? 15% per year for 5 years, okay? And then after 1 year, for example, the CBK, the RMB in this case, announces that the base lending rate has gone down. But Kenya just announced a reduction of the base lending rate by 0.75, and most banks 0. It may seem very, very minute, but to banks that's a very, very in finance and generally treasury management, that's a very, very huge, significant reduction. Okay, so the CBK, the Central Bank of Kenya, just announced the base lending rate reduction by 0.75, and banks obviously have to follow suit even if you check, if you look up, Equity Bank, one of the leading Taiwan banks in Kenya, have announced a reduction in their base lending rate from 12.75 back to 12. I mean that is excluding also the the risk-based pricing that I told you about that Kenyan banks currently use, and such risk factors of, for example, who they lend to.
Oh, so they brought it back to 4%.
Yeah, you can look it up. Okay. Just even search Equity Bank reduces equity lending rate. Oh, not online. Anyway, it is, you can, after 1 year, or let's say after 2 years, the Central Bank of Kenya, or in this case the Reserve Bank of Malawi, announces let's say even a 2% or 1% reduction in the base lending rate. Then you'll need to reprice your even existing, because when the CBK or the RMB announces such rate reductions in the base lending rate, it affects not only new but also even existing loan portfolios, right? At least in Kenya it does. So you'll need to reprice your loan. Okay? Let's say it was 15% and now it's now 13%. But then the customer you lend to at 15% says, let me take advantage of this CBK reduction or RMB reduction before, for example, the RMB announces it a hike in the base lending rate to even 18%. It was sometimes at 18%, 17% just a few months ago. So the customer takes advantage and, for example, even prepays there. So in that case, you will have lost and you will have faced an interest rate risk, what is called an optionality risk.
Yeah.
Okay, because the customers have the option to prepay, especially if they want to take advantage of rate reduction. So especially in you find this very very common in, for example, long-term securities such as mortgage-backed securities. Okay, so let's say a customer has a 30-year mortgage, okay, and the mortgage rates reduced. They can even offer to prepay their mortgages. Right? It's very very common. If you look at U.S. statistics, it's very very common. It's regarded as one of the strategies, one of the good finance strategies. I mean, I don't know how to put it. Good finance strategies. You can take a mortgage, but then prepay when the mortgage rates come down.
Okay.
Yeah, mortgage rates. Mortgages, being it's a long-term security, they're usually very sensitive, and if you take advantage of such, for example, cut in mortgage rates, then you can end up reducing your overall, for example, what you will have paid over, for example, okay? So that risk, so you as a customer who will have taken advantage of that rate hike, of that rate cut, will have benefit, but the bank will have faced an interest rate risk called an optionality risk and even made losses, because that 2% reduction will lead to losses. Okay, as we saw even in the gaps, we were able to analyze similar, for example, interest rate gaps. And what will that even, it will even impact the net interest income that will have. For example, the gap, in that case, it will be like we did it in the ALM when you were doing a stress test. And then here is where I can introduce this concept, stress testing. So in this case, let's say there is a 1% cut. The CBK or the RMB announces a 1% cut in the base lending rate. Okay, and customers, take advantage, and then you start by taking the gap by the. For example, if the gap was a negative, by, let's say, just any bank, different this balance sheet, let's say cash and cash equivalents, C and CE, of 20 million, that is supposed to repay immediately at a fixed rate. Okay, because cash and cash equivalents, interbank in the bank market short-term loans of 200 million that you are supposed to pay back after 5 years. Pay back